Welcome to the deep dive. Today we're jumping into behavioral economics. It's all about how our minds really shape our financial decisions.
Exactly. We've got some great material here that explores the psychology behind it all.
And our mission really is to pull out the key insights from this stuff to help you, the listener, get a better handle on these psychological forces influencing your own economic choices.
Yeah, because traditional economics, it often paints this picture of us as, perfectly rational calculators.
Always making the logical choice.
Right. But behavioral economics kind of steps in and says, well, hold on. We're people. Psychology, emotions, biases, they all play a massive part in how we actually deal with money.
Okay, so let's break that down. The core difference. What really sets behavioral economics apart?
Well, think of traditional models as describing how we should behave, ideally. Behavioral economics looks at how we do behave. It accepts all the quirks, the biases, the emotional stuff.
Right, which leads us nicely into cognitive biases, these sort of systematic glitches in our thinking.
Precisely. They consistently nudge our financial choices away from pure rationality. Like loss aversion is a big one mentioned here.
Ah, yeah. Tell us about that.
Well, it's fascinating, really. The psychological pain of losing, say, $100 feels much, much stronger than the pleasure you'd get from gaining $100.
Huh. So we hate losing more than we like winning.
Pretty much, yeah. And this makes us maybe overly cautious sometimes, like avoiding reasonable investment risks or maybe holding on to losing stocks way too long just because selling makes the loss feel real.
That makes total sense. Nobody likes that feeling. Okay, another one mentioned is the anchoring effect. I feel like I fall for this one.
Oh, it's incredibly common. Anchoring is when, like, the first piece of information we get, the anchor just sticks and heavily influences whatever judgments we make next.
Even if that first number isn't super relevant.
Exactly. Think about shopping. You see a jacket marked down from 550 pounds in Townsend. That 500-pound anchor makes 250 pounds seem like a fantastic deal, right? Even if maybe 250 pounds is still quite a lot, it works in negotiating, pricing, all sorts of things.
So that first number just sets a mental benchmark. Wow. Okay, what about bigger picture stuff? Emotions, fear, greed, market bubbles. How does that fit in?
Oh, they're huge drivers.
Yeah.
When markets are booming, greed and FOMO, fear of missing out, can pull loads of people in. Sometimes they invest without really looking at the fundamentals, the actual value.
Just following the crowd up.
Right. And then if things start to wobble, fear takes over. That can trigger panic selling, which just makes the downturn worse, faster.
Hmm.
These emotional waves can create huge bubbles and crashes that aren't strictly based on rational economics.
Okay, so to maybe help us avoid some of these traps, there's this idea of nudging. What's that about? Sounds a bit subtle.
It is subtle, that's the point. It's about designing choices in a way that gently nudges people towards a beneficial option without actually restricting their freedom to choose.
Like how? Give me an example.
Okay, a classic one is automatic enrollment in company pension plans. You're in by default. You can always opt out, but most people stick with the default. It makes saving easier.
Ah, okay. Making the good choice the path of least resistance, sort of.
Exactly. Now, the material also talks about herd behavior, especially in stocks. How's that linked to the fear and greed stuff?
Good question. They're very closely related. Herd behavior is just that tendency we have to, well, follow the group, do what everyone else is doing.
Even if it's not logical for us individually, sometimes, yeah.
Hmm.
In the market, it means buying when everyone else is piling in, often near the top, and panic selling when everyone else is running for the exits, often near the bottom. It amplifies those emotional swings.
Not always the smartest herd to follow, then. And businesses, marketers, they must know all this, right? How is behavioral economics used in marketing?
Oh, absolutely. They leverage these biases all the time. Think about limited time offer or only 3 left in stock. That taps right into loss aversion, the fear of missing out,
Makes you want to grab it before it's gone.
right? Or showing a high original price next to the sale price that's anchoring, making the deal look better. It's pretty ingrained in modern marketing strategy.
Sneaky.
Yeah.
Okay, another concept here. Mental accounting. I feel like I might do this.
Most of us probably do, maybe without labeling it. It's how we sort of mentally put money into different buckets based on where it came from or what we intend to use it for.
Like, bonus money feels different from salary.
Exactly. Even though, rationally, a pound is a pound, right? You might feel freer spending a tax refund or a small lottery win than you would spending your regular paycheck on the same thing. It definitely affects spending habits.
Yeah, that found money feeling. Okay, lastly, overconfidence. especially mentioned for entrepreneurs, investors.
Yeah, overconfidence is a tricky one. It can be good, it might give someone the sheer drive needed to start a risky new business or make a bold investment. That's self-belief.
But the downside?
The downside is it can lead people to seriously underestimate the risks involved, overestimate their own skill or knowledge, and maybe make decisions that aren't well-grounded. Thinking you're a better than average investor, for instance, could lead to taking on way too much risk.
So wrapping this up then, for you listening, the big takeaway seems to be that just understanding these psychological forces, loss aversion, anchoring, emotions, hurting, all of it can make you much more aware.
Exactly. Awareness is the first step. If you can start to recognize these biases, potentially influencing your own financial thinking, well, that gives you a chance to pause, reflect, and maybe make a more considered, rational choice.
It's about moving away from those automatic, sometimes flawed mental shortcuts.
Precisely. Towards more intentional decision-making.
Okay, so here's something to chew on. Think about your own financial life right now. Which of these biases we talked about, maybe loss aversion, maybe anchoring, perhaps herd behavior, or even overconfidence or mental accounting, which one feels like it might be playing the biggest role for you? And just consider what could potentially change if you actively started to notice and maybe gently counteract that specific tendency. Definitely something worth thinking about. Thanks for joining us for this deep dive.